Hello friends, welcome to Make Money While You Sleep channel. My name is Varun and today we are going to learn how to buy stocks cheaper than market using options. So let's begin. Few disclaimers. This content is purely for educational purpose and it is not intended to be an investment or a financial advice. So before we move ahead, let's cover a couple of option basics for those who are completely new to options. I have covered option basics in detail in my other video, which I'll put in my description of this video, but let's quickly cover them here. So option is nothing but a contract on 100 share, which has got a defined expiry date and a strike price. There is a buyer and a seller, just like any other trade. A buyer buys an option contract from a seller by paying a small premium. Options work just like an insurance, and there are two type of options, call and put. Again, I have covered all these basics in detail. For somebody who is completely new to options, I would suggest to go ahead and watch that video too. So first of all, let's try to understand what is moneyness in an option. So moneyness is nothing but, in a layman terms, you can just think whenever a buyer of an option is going to make money, it will be called as in the money status of the option. And whenever buyer of an option is going to lose money, it is going to be called as out of the money. And whenever there is no buyer is not making too much money or not losing too much money, he's pretty much at a break even, it's called at the money, which generally happens when strike price remains near to the stock price on the day of expiry. So for example, buyer of a call at strike price 50, and let's say stock goes to $60, buyer was bullish of a call, and so he's going to make profit, hence it is in the money. And if his stock goes down, then he is going to be out of the money option. And if buyer of a there is a buyer of a put at strike of $50, and let's say stock goes above $50, let's say it goes to $60, a buyer of the put who is going to lose money, hence it is called out of the money option status. And if that put goes down as per the bet of the buyer, buyer is going to make money, hence it is called in the money. Because this is the concept what we are going to use in this particular strategy, and I'll show you how we are going to use it to buy stocks cheaper. In this particular example, or in this particular strategy, how to buy stocks cheaper using options. So you remember we have covered this particular example of put, where if there is a buyer of a put and he is going to make money or lose money depending on the stock price. To apply this strategy of buying stocks cheaper, we have to become a seller of a put and have to sell put either in the money or at the money so that we can get those stocks at a cheaper price. So how do we do that? So for let's take the first scenario, sell put in the money. So if it is sell put in the money, basically your strike price will have to be higher than the actual stock price. For example, in here it is $50 strike price and stock is of $40, right? So I have given a real life example here. So bingo is at $11, while my strike price is $13. So this is a in the money sell put over here, and I'm selling a put for February 19th, and I am collecting $2.65 per share as a premium. Hence, on the day of expiry, if bingo does not go above $13, what will be the break-even price for bingo or for the assignment? It's going to be 13 minus 2.6, that is $10.32. So imagine if bingo does not do any movement, bingo remains $11, $12 until Feb 19th. This particular stock is going to be assigned to me on Feb 19th at the price of as a break-even price of $10.32. So you can easily see an example over here where the current price is $11, but you are able to get this stock cheaper, right? So let's look at other scenario where I'm going to sell put at the money. At the money means my strike price as well as my current stock price are almost same. So let's say bingo current price is as $11 and I'll also keep the strike price $11. And in this particular scenario, I'm going to collect $1.33 as a premium. So on Feb 19th, if bingo will go below $11, let's say even $10.99, this particular option is going to be assigned to me. And what will be the break-even price at that time? It will be 11 minus 1.33 equals $9.67. So you can see uh, that break-even price when we are selling at the money put is way lower as compared to the in the money sell put. And one more thing which I want to make you observe is you can observe the premiums are higher here. It is $2.68 when it is in the money, and premium is lower here. However, your break-even price is actually lower in the at the money. So I just want to make you observe this thing, that while it looks like premium is high, but the break-even price is going to be lower for at the money option. Having said that, a lot of people might have a question about what about out of the money, OTM. So OTM is also a good strategy. However, if you are looking for buying stocks cheaper using options, OTM may not work because your strike price is going to be a bit away from your actual stock price. So the stocks are not going to assign to you. It's highly possible, right? So sell put OTM, which I use most of the time, it is mainly meant for safe trading or passive income generation. It may not let you get the stock assigned. So typically we don't intend to take assignment while selling put or out of the money because it won't happen. But if it happens, it's really great. I mean, you're going to get stock at a very low price. So it's also good if it happens. But many a times it does not happen. Hence, if you really want to get hold of stocks, either you should do in the money or at the money. So key takeaway, guys, options have got a lot of options. In this particular strategy, you can buy stocks cheaper by using options assignment tactically. So it's not the direct way of doing it, but the way options work, you have figured out a way and of using them to buy stocks cheaper. And for this particular strategy, if you are going to sell put in the money, it will give you the best premium, but it will have a higher break-even price as we have seen in the example. But also the chances of assignment is higher. So depending on your aggressiveness, whether you want to have that stock for sure, you may want to either sell put in the money or you may want to sell put at the money. Now sell put at the money can give us the lowest break-even price, which is good for us, but chances of assignment is just 50% because at the day of on the day of expiry, stock may go up or may go below that particular strike price. Uh, One of the caveat or you should know about it for sure is that you are whenever you are using options to buy stocks, you are always buying in a lot of 100. So it cannot happen that you can buy a smaller lots. And this is not a good strategy to day trade and do some short-term trading. You should always try to use this particular strategy when you are looking for long-term collection of stocks or long-term holding of these stocks, because there is an expiry date involved and you might have to take some time to get hold of these stocks. So while in day trading and short-term stock trading, you are generally looking for very fast turnover. So it may not be a good strategy for those kind of scenarios. So that is it, guys. I hope you are able to understand this particular concept. Feel free to ask me questions and provide me a feedback. If you are interested to learn more about the options and get my trade alerts, you can join as a premium member in the URL which I have given here. And I will see you again next time. Thanks a lot. Uh, have a good day.